In this video, I will show you the ultimate capital allocation guide, how companies generate wealth for their shareholders. I have a template here for you. I will explain the different steps. Capital allocation framework. I will explain the framework, explain the different steps, give you examples how companies generate value for shareholders and how some companies destroy value for shareholders. And if you have to choose, you want to invest in companies that create wealth for you, the shareholder. So obviously you have to ask some questions, do some analysis, and this is a template for your analysis. So you can take a screenshot here and you will have it if you want to continue your analysis. Welcome to this YouTube channel. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year because I focus on companies that create shareholders value. Basically, that's very simple. So, okay, let's start. Imagine you want to invest in a business and you want to see if they are good with cash. Maybe they have debt, maybe don't have debt, okay? You like the story, you like the management, you like the numbers, the growth, and you want to see, okay, are they good with the cash? Is this company going to generate value for me, the shareholder? To do your analysis, you have to ask some questions. The first question you have to ask yourself is, does the company have high internal reinvestment opportunities? Meaning return on capital superior to 15%. You can check the return on capital. You have different metrics. I'm using the ROIC, return on invested capital, but you can also use other metrics, the return on equity, ROE, or return on asset, ROA, or return on capital employed, ROCE. You have plenty of metrics. I'm using the ROIC. You take into account the debt and everything. I like it better. Okay, in case you are looking at the company with the high ROIC, superior to 15%, higher than 15%, yes, it's better for the company to reinvest their profits into the business, like the Amazon way. You want to reinvest and reinvest and invest, and you let the compound effect do the work. You increase the snowball effect. So yeah, you have in blue, reinvest in the business at a high rate of return. If you think you can perpetually grow your profits if you reinvest by 15%, 15, or even more, 20, 25%, 25%, in this case, it's better to reinvest everything you have. So now imagine I took the example of you analyzing a stock. Do you check the ROIC? Is it consistently above 15%? And what has the management done? Did management do buybacks, dividends, or did they reinvest everything they had into the business? Normally, the best capital allocators will reinvest everything inside the business if they have a high ROIC. So please check. And if they don't reinvest, maybe they make a mistake. That's your judgment after all. So in case you don't have a ROIC superior to 15%, in case you don't have internal reinvestment opportunities that can generate 15% growth, return on investment, the recommendation here is to not invest in the business. And you ask the second question, do you have debt? Does the company have high debt that has to be paid soon? Sometimes you have maturities that are due. Sometimes you have to pay your debt in the coming months. So you have to use the cash to pay off the debt. If you have a lot of debt that has to be paid down as a company, pay down your debt. That's maybe your best use of capital. You want to be safe. In the stock market, in the world of investing, people sometimes they make a mistake, they avoid the debt, they fall into the traps. So it's better to just avoid companies with debt, basically. So you don't even ask this question. But in case you have a company with some debt, pay off your debt and then you continue to grow nicely. So if you have some debt that has to be paid soon, like the next maturities are soon, pay down debt. If this is long-term debt that is due in 2032, just wait. That's fine. You can continue with the next question. Is there an attractive acquisition opportunity? I don't like M&As. I don't like acquisitions, mergers, because that's a lot of deception. That's a lot of promises from management. They expect beautiful synergies, margin accretion, and most of the time the synergies don't happen. So it's a blatant lie to shareholders. So I don't like M&As. If you have an attractive acquisition opportunity, it's very clear it will create synergies. You don't take a lot of risk. You don't take a lot of debt to do the acquisition, and you are dead sure about creating value for shareholders. If this is the case, you can do the M&A. That's how companies think. Good capital allocators must think. If you have a good opportunity, you assess the risk reward, you do the M&A with caution. You always compare the return on investment, the ROI, with other alternatives, paying debt or reinvesting. I would not like to invest in companies with a lot of M&A activities, but some investors, some of my viewers like M&As. It's a very hard, complex investing style, I would say. But in case you have a tremendous opportunity, please act with caution. And if you don't have a tremendous buying opportunity, merger opportunity, you just return cash to the shareholders. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. How do you return cash to shareholders? You ask another question. Is the stock undervalued? If you are a CEO of a company, you have to monitor your stock price, because it will determine if you do certain actions or not. That's the job of the CEO, CFO, somebody in the management, or the board of directors. If the stock is undervalued, it's better to do buybacks. You do buybacks when the stock is cheap, like the valuation drops, the stock drops, and the stock is extremely cheap, and I mean, that's a good moment to invest in yourself, right? Imagine this scenario. You are a CEO of a company, great company, growing profitably. The PE ratio is 10, and then the stock price drops. Boom, PE ratio goes from 20, PE ratio goes to 10. What do you do with this situation? The stock is maybe cut in half because of a temporary trouble or because of a lockdown or any scenario. What do? You assess your situation. First, are you still alive? Yes, you are still alive. You check yourself. That's fine. Operations, fine. Okay. Do you have reinvestment opportunities? If so, you can reinvest always. That's the same pattern. If you have debt, you just repay the debt. If you don't have M&A opportunities, you ask yourself, how do I reward the shareholders? Either I keep the cash in my balance sheet or I reward shareholders. If the PE ratio is 10, it means an earnings yield of 10%. You just reverse the formula. PE ratio of 10. PE ratio is what? Is the stock price divided by the earnings per share. So you just reverse the formula. So instead of being a PE ratio of 10, that's an earnings yield of 10%. So your opportunity is 10% if you do the buybacks. So you compare 10% with the reinvestment opportunity. If you have a reinvestment opportunity in a side project and that will bring you a rate of return of 6%, you compare 10%, 6%. No, it's better to do the buybacks because the percentage is higher. Okay, then you compare this to your debt. Do you take more debt or pay off your debt? What is the percentage? What is the yield, the interest on the debt? 1%, 3%, 6%. It depends. Acquisitions, same thing. So most of the time when the stock is undervalued, it's better to do buybacks, to use all the proceeds, all the profits to do buybacks. And you have some companies that have understood this. You have companies like NVR, that's a US home builder. You have companies like AutoZone or AutoNation. These are 2 car dealerships in the US. You have Pult Homes, by the way, also does the same thing. Second home builder in the US. NVR, Pult Homes, great home builders, great companies, and good buyback cannibals. You have other candidates. You have also, if you want to have some fun after this video, you have Fair Isaac, FICO, ticker symbol FICO, that did some buybacks in the past when they considered the stock undervalued, like in 2021, 2022. And when the stock rebounded sharply, the stock was no longer undervalued, they stopped the dividends. They just stopped and reinvested internally, etc. So if you are a good capital allocator, the way to think about dividends, about buybacks, is very simple. You just wait for the price to become cheap. And every time your stock dips, the valuation is cheap, you do buybacks. And then the stock rebounds and then drops for some reason, you do again buybacks. You are opportunistic with the buybacks. That's the best use of capital. You had some talks on the internet, if you can check. That's from Monish Pabrai, that had a complete masterclass on buybacks and how companies created a lot of value for shareholders only thanks to buybacks. They have good operations, good buybacks cannibals. We call them Uber cannibals, companies that invest in themselves. Because if you buy back your share, what do you do after all? You just buy your own share. You invest in yourself. And if you have an earnings yield of 10%, you can get an internal rate of return of 10%. You compare 10% with all the opportunities. So 10% is your opportunity cost. And I used an example with a PE ratio of 10, but the PE ratio can go to 5. If you have a PE ratio of 5, you have an earnings yield of 20%. If you have a PE of 5, I would say just do the buyback. Do the buyback. So heavy buyback. And you will see, by the way, if you run a screener or anything else, you will see some companies with the valuation completely cheap. They have a PE ratio of 5 and they do extreme buyback programs. Like they buy back 15% of their shares in 1 year. And then the next year, again, 15%. That's wonderful. I mean, you can check AutoNation. I think it was in 2020 or something like this. In 2020, they bought back 20% of their shares. That's enormous. Like they invested in themselves. The next year, they bought back again 20% of their shares. Back to back. 2 years in a row. So you can drastically reduce the number of shares. Okay? What happens if you drastically reduce your number of shares? That increases your EPS, earnings per share. Earnings per share, you take the net income divided by the number of shares. So if you reduce your denominator, that boosts the earnings per share. And over the long term, stock prices follow earnings per share. So if you boost your earnings per share for the long term, you boost your stock price and you create value for shareholders. You have so many examples of this. So many examples. You have, one I love and I have in my portfolio is AutoZone. They have increased their over the past 20 years. They have improved their operations a little bit, increased the revenue by a little bit, only doubled. Okay, they have improved efficiency over the years, more margins. Okay, and all the cash, all the free cash flow was used to do buybacks when the stock was cheap. And if you look at the earnings per share growth, over the past 20 years, they have grown earnings per share by 20%. 20% per year for 20 years. And guess what? The stock price had a 20% growth for 20 years. In the very long run, stock prices follow earnings per share. So you want to boost your earnings per share. And buybacks are a great way to do this. And what if the stock is not cheap, is not undervalued? What do? The alternative is to pay a dividend. If instead of having a PE ratio of 10, you have a PE ratio of 45, that can happen. Some companies, you have the Costco's of the world, always have a high PE ratio. The best way is not to do buybacks. If you do buybacks at a high price, you dilute shareholders, you destroy value. That's not the best use of capital, because the same way we had an earnings yield of 10% with a PE ratio of 10, if your PE ratio is 50, the earnings yield is 2. So your opportunity cost is 2%. You have other stuff to do with your cash. Come on. Do some reinvestments here and there. Pay off your debt. So I would say some companies focus on buybacks only when it's cheap. It's better to do it this way. You have other companies, I won't name names here. You have some companies in the US that do buybacks even when their stock is expensive at a high PE ratio, more than 30. That's a complete destruction of value. That's a complete destruction of value for shareholders. Seems like they don't care about the shareholders. You try. I hope that this video makes it clearer for you. And the goal of this video is to also understand management. If you do this long enough and you focus on AutoZone, NVR, etc., all examples, you do the track record, you do the analysis. You can check, for the example on the internet, over the past 20 years, the PE ratio of the stock. And you check for all the time the stock dipped, did they increase the buyback program? That's a good indicator. You want to compare, if you want to see if the management took opportunity and bought more shares when the stock was trading cheap. The goal of this video is to understand this framework, okay, but also to understand management, because at the end of this exercise, you will know if management care, if the big management teams care about shareholders or they don't care about the shareholders. Because if you do some buyback program at an absurdly high price, you just destroy your value for shareholders. If you have a PE ratio of 50 and that means an earnings yield of only 2% and you do buybacks still, you completely destroy value for shareholders. So literally you don't care about the shareholders. You burn cash. That's stupid. I mean, that's not the way we want to invest in stocks. We want to invest in rational management that take advantage of the opportunities, that think about opportunity costs. So you only want to prioritize investing in companies that do buybacks when the stock is cheap. When the stock is not cheap, so PE ratio of 50, like Costco, for example, you just pay a dividend. That's safe. You don't do dumb stuff. You just pay a dividend, either a regular dividend or a special dividend, and that's fine. And you see this pattern. You have some questions. You can ask these kind of questions for every year. And what is great about public markets is that you can check the track record of companies. So if a company has been public for 20 years, you can check the history and what they have done when stock price crashed in 2020. When the stock price crashed in 2015, for example, or 2008, you can check what they have done to reinvest, to pay down the debt, if they did some M&A, and how did they reward shareholder. If you do this properly, you will only keep the best investment opportunities, you will only keep the best management teams, you will only keep the best steward of capital allocation that will create value for shareholders in the long term. And I guarantee that if you only invest in companies that reward shareholders, that care about the shareholders, you will outperform everybody. These are very rare, all the companies that are perfect, good capital allocators, etc. But if you find them, you will outperform and you will have great results. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.